Thanks, Chad. Thank you, everybody. Thanks for being here. This is a really exciting topic for me. I started my career at Oracle as an engineer, where everything I was developing was very much on-premise. So I think we've come a long way since then, and it's going to be fun to talk about. So why don't we start? Well, first of all, let me just try to get a sense for who we are. And I think we've been cut short a little bit by all the traffic and everything, but entrepreneurs, first-time founders, okay. Company, other founders, early execs, okay. Investors, okay, good, that helps us. Why don't we start? Byron is going to has graciously offered to do a quick first introduction about cloud generally, where we are, kind of the update. So we can jump through that and go from there. So Byron.
Great. Hello. Excellent. We're live. So I've got just a few slides to set the stage, and we've got an awesome panel set up for you guys today, which will jump into the real meat of things. This is some content that we have available up on our website, etc. Jason and the Emergence team have a lot of similar content available in terms of cloud meat. The entrepreneurs you're going to hear from today are living this every day, and so I'm just going to spend a few minutes, and then as we dive in, a lot of these themes will roll through. But the fundamental question for us to discuss today is the state of the market. What are we seeing, and what should you, largely as entrepreneurs and in some cases also investors, do about it in the context of the environment? And so this is one of the high-level charts that perhaps gives some people some joy or trepidation, depending on which side of the landscape you're on. Whether you've got a long portfolio that's enjoyed the run-up, or if you're an entrepreneur or investor just looking to get into things. There's no two ways about it. For the cloud sector in particular, and then if you take the lens up one level higher, which we're not going to do in raw data, but we'll do in the anecdotes and the discussion of the panel, across tech more generally, it's been a heck of a run. We've enjoyed over the last several years very strong growth in terms of core business fundamentals, and then in terms of multiple expansion market dynamics, there's been a run-up that people are starting to compare back to the 2000 run-up. And I think the fundamental question is, do people think of it more as 1997 today, or as March 2000, and how should we act in that environment? This chart, just to set the stage, shows an index of what are now 38 pure-play public cloud companies relative to the major indices, the S&P, Dow, and NASDAQ. And as you can see, we're up about net 130% over this time period, going back to Jan 1, 2011. If you think of it, though, on a multiple basis, this perhaps gives people a little more comfort. We certainly got to a point of some real enthusiasm approaching 10x on a next 12-month revenue multiple basis at the high point this year. Things pulled back dramatically, and we're sitting closer to what has been over this extended period, a 6x revenue multiple range. Certainly when you compare this to the on-prem peer group, that still feels healthy. And just to clarify, the 5.4x you see here relative to the 6.1x, this is a 2015 revenue multiple, and that was a 12-month multiple, including Q3. So it's just slightly different time periods, but it's the same data set. But fundamentally, if you think in terms of 5.4x for 2015 revenue, does that feel crazy? Does that feel comfortable? Does that feel potentially conservative given the fundamental transformation that we're seeing within cloud, the replatforming that's going on, and the quality of businesses? I think there's still some room for debate on that. When you talk to a lot of the core cloud investors, you look at things, the first thing they'll comment is that some multiple premium is deserved just in terms of how the financials are handled. Cloud companies, by definition, subscription businesses by definition actually, are somewhat disadvantaged by GAAP in that they have to defer rev rec and amortize it over the life of deals, and they have to front load costs because of how, again, the accounting principles push people today. And so for a business growing at 30%, which the average group in this 38 company peer set is growing at a mean of 28% annually, so still fantastic growth for large public companies, that handicaps them by 15% or so, and in these multiple ranges, you could argue that a full turn on the multiple is simply a business model adjustment to make it apples to apples. Then you get into fundamentally, are the businesses more interesting? And at 28% growth rates, at category leadership positions in this new wave of cloud computing, et cetera, we've at least talked ourselves into the fact that this premium is justified relative to the on-prem peers. And so the absolute question is much more, how should the market move collectively? We're quite comfortable with this trade, that the cloud revolution is well underway, that they are cannibalizing the on-prem world, and that a modest premium, and frankly we probably are paying in private deal certainly a much larger premium to get the cloud leaders in those categories is justified. But the question, more broadly is what is fair value and what should entrepreneurs be doing in the context of what still feels like, healthy forward revenue multiples in an absolute environment. And so to frame things a little bit more in terms of the private landscape, which will be the bulk of the discussion today, it's not just the 38 public companies that are getting strong, frothy valuations. There's a long list of private companies that either have done recent transactions or have done transactions, a year plus ago that with their current growth rates would imply $1 billion plus in current value. Long list directly here. And then if you take the lines out even one level wider, there's 300 plus pure play private cloud companies that are at some meaningful scale today. This is a holistic industry group. Emergence has a great vertical cloud industry map as well, and some other content. But we didn't hold anything back in this chart in the sense that for it to be credible, we essentially put our deal pipeline out there and our view of the landscape, and have attempted to put some structure to it to just orient you. Application companies on the top, software as service providers. The middle stack here is a blend of the platform as a service provider, so the PaaS layer, and then infrastructure as a service below. In terms of market adoption and liquidity, SaaS hit first in terms of pure plays with the advent of Amazon Web Services and with a number of the kind of tech opportunities here. You've seen the recent real coming of age of PaaS and the infrastructure layers. But there's 300 plus pure play private companies that are all of some very interesting scale and growth trajectory today. And frankly, there's thousands behind this group, all creating that next wave of disruption that are feeding into the private cloud unicorn group and then the pure play publics. And so I assume that many of the entrepreneurs in this room are current candidates that some of you I recognize are already on this list. Many of you are aspiring to be on this list. And so what we'll endeavor to do today is provide some feedback, Q&A, et cetera, to jump into how should you be acting as entrepreneurs in this environment. What are the collective lessons that we can learn from each other to help navigate what is overall a fantastic time to be an entrepreneur. Certainly in the last 14 years, this is as good as it's gotten. And you could argue that with the tech enablement and the tailwinds around the trend for people that are approaching cloud software, mobile, or consumer internet, that it's the best time it's been in the history of innovation, where you've got the infrastructure service providers out there to allow you to get into business for dollars a month to put content out there, where you've got access to cheap capital from folks like us that are optimists at heart and not value buyers, so we're still investing actively in this market. And then you have an enabling set of technologies, customers, partners, et cetera, to fast track growth. And that combination of circumstances is extremely unique and fundamentally puts the Valley and the tech industry as a whole in a pretty fantastic spot, which I think will be the lead-in to this esteemed group of panelists who I'm thrilled to be with. So I'll hand it back to you, Earl, to
Thanks, Byron. That was terrific. That's a great overview. So I think we'll use that as part of this discussion. So Vic and Kirk, do you guys want to come back up here?
Sure.
So why don't we start by having each of the panelists introduce themselves. So we can just start. Maybe Kirk, do you want to get going on that?
Sure. Can you hear me now? Perfect.
I feel all left alone here, but that's fine.
That's all right, scoot over.
No, we do want to use this for a second, so go ahead.
Okay, very good. So good morning. My name is Kirk Dunn. I'm the Chief Operating Officer at Cloudera. And for those of you that don't know what we do, we've commercialized a technology called Hadoop that was effectively germinated at Google, and we have brought it to enterprise organizations so that they can effectively use all their data that they possess to get better analytic results and understand their customers and their products and their markets better.
Good.
Hi, I'm Godard Abel, CEO of SteelBrick, and I realized I didn't follow the instructions because I was up here too early with Byron and Jason, but anyway, I'm not a VC, I am an entrepreneur, and actually now running a company called SteelBrick, and we're a next generation CPQ, which is sales configuration pricing quoting software company. We have a lot of great customers, actually proud to have Cloudera as a customer, so we work with Lars Nielsen, whom you probably know, but we help a lot of companies like Cloudera that are growing fast to automate their sales processes and allow them to add salespeople and revenue more quickly. And so excited to be here. And also, we did just raise a few months ago capital from Emergence Capital and Jason, and now just using that capital to scale up. So excited to be here, part of this panel.
Jason Green with Emergence Capital. First of all, thank you for using an old picture. I think I had more hair back then. I've been in the venture business a long time, so I can use dated pictures of myself, which is great. I was fortunate to get into the venture business early with firms like Benrock and USVP, and then back in 2002, during the last bust, decided to start my own firm with two other gentlemen. And we focused in a little area called the cloud back then. We didn't call it the cloud, it was more software as a service, actually called ASPs, if we remember back then. And our first investment was Salesforce.com. And it's amazing when, Byron showed a lot of valuation metrics there, but what gives me conviction about the space is having seen firsthand, the first Dreamforce was like 300 or 400 people, and now it's 100,000 people show up for that conference. And Salesforce maybe did, 20 million or something run rate when we invested. Last quarter, I think they're at a $5 billion run rate with $1 billion of cash flow. I mean, that's an amazing thing to watch over a dozen years, and many of the next generation companies, the success factors, the Yammers, the Boxes, are on that same trajectory. So that's what gives us conviction.
My name is Singh. I'm the CEO and co-founder of a company called Infer, and what we're up to is we basically provide a predictive SaaS platform to help companies predict their next customer. So we help sales and marketers identify which leads will turn into paying customers, and we do that with a bunch of math and science that we picked up while working at Google and Microsoft and a bunch of the consumer companies. And it's been a great ride, and we've been growing. We launched early mid last year. We raised $10 million from Andreessen Horowitz and Redpoint and a few other investors, and we've been growing our customer base and our revenue bookings, basically doubling quarter over quarter since, and it's been a fun ride.
Great, and then just some added context on myself, Byron Deeter, again with Bessemer Venture Partners. We are a global firm managing about $4 billion in assets across 6 offices. We have about 80 cloud investments at this point, ranging from a number of the early public companies, Cornerstone On Demand, Eloqua, LinkedIn, which is 80% SaaS, LifeLock, BroadSoft, etc. A number of the later stage private companies, including several joint investments with Emergence, Box and Intact, Twilio, etc. And then myself, I was entered venture in the late 90s and then was a founding CEO of an early SaaS business, so I've lived the world through the ups and downs, and we were fortunate to have a great outcome in the mid-2000s. And I rolled over to Bessemer and have headed up our cloud practice globally since then. And then as a firm, we also have had a good amount of success in consumer internet and mobile as well, companies like Pinterest and Yelp, et cetera, in the portfolio. So fairly broad tech landscape.
Thanks, Byron, that's great. So I thought we should maybe start with the last topic that you addressed, which is kind of some of the factors of why we're here. Because I think it's helpful to understand what's kind of brought us to this point. So I think you mentioned just the availability of past providers and capital and so forth. Curious if you want to maybe talk a little bit further about that, and maybe is there anything that you see as kind of the key driver in this, and in terms of what's causing valuations to rise and the interest in funding activity, et cetera? And then I'd love to get the thoughts of the other panelists around that, and maybe what you feel are other issues or factors that we should be thinking about.
Sure. So quick answers from two sides. From the entrepreneur side, I think the reason why we're seeing the proliferation of companies is that it's a great time to be an entrepreneur. So you've got access to a lot of market enabling factors and a willing customer base that's now looking cloud first in a lot of buying decisions. From an investor standpoint, it's plain and simply greed, in the sense that we believe that this is a gold mine and a money-making opportunity, you don't get a lot of replatforming opportunities in tech. These cycles come around in decade-plus intervals, and so to be at what we think is still the front end of a complete disruption of this trillion-dollar tech economy, where certainly software, but even hardware and services are completely up for grabs as you roll this into an on-demand computing environment. We feel like for businesses that are growing, at the growth rates that our fellow panelists are here, the way we talk ourselves into it is even if you pay a healthy multiple, if they're growing through it, you can still have a fantastic venture return if they end up being category killers. And admittedly, it's a bit of a self-perpetuating cycle where things escalate, but to date, people have been guilty of crimes of omission more than commission, and wish that they'd done more, and so it feeds on itself a bit.
Vic, others, I mean, what do you think about kind of what brought us to this point?
Yeah, I think in addition to what Byron mentioned, I think there's just a lot of growth too. I was talking to our investors and just kind of looking at some of the portfolio companies. There's a lot of great portfolio companies who are growing well. And these aren't companies who are raising dumb money or playing some of the .com games or people being greasy and changing deals and that sort of thing. They were there was real value that they're generating. And when you have a lot of companies who are doing really well, and you also have a lot of availability of cash, you have a lot of investors who want to get into it, it just creates a dynamic where you have a lot of bidding and you have a lot of big rounds that are going to take place and people are willing to pay forward on the multiples. So I think that's great for us in terms of the entrepreneurs, especially if you're a company that's doing well. Just from at least from the VCs and the top tier VCs, I would say that the decision-making criteria they have for determining what companies are going to go all in on is still a very high bar because of the fact that you have a lot of companies who are growing and generating real revenue. You have a lot of companies who are going into the Series A who are cash flow positive or have revenue, who have millions in ARR, which is not the case necessarily before. So I think there's a lot of factors that are leading to a very different environment than .com time, but also leading to a surge in the valuations.
What do you think, Jason? Any thoughts on that in terms of other, and also maybe anything macroeconomic in your mind in terms of what's driving this? Well,
the Fed has certainly helped. Easy money certainly helps. It just keeps the economy flowing. But I think the two fundamental things I see, one is just long term. We are in this incredible technology disruption process where we've got two actually waves occurring, right? We've got cloud and we've got mobile. And cloud's about 12 years old, and mobile, I view, is almost 7 years old because that's when the iPhone came out. And those technology waves tend to last more like 15 years. So we've got two huge disruptive waves now that are it's like tsunamis coming on top of one another. So the fundamentals are incredibly strong. And then I think the markets, react to fear and greed. It's a horse race between fear and greed. I don't think you can frankly, I don't think you should be managing your business too much by kind of what the multiples are currently because they fluctuate so dramatically. You've got to kind of take a little bit longer term approach and obviously take advantage of markets like this. And then the third thing is role models. I think there's a lot of great entrepreneurs that have started companies, built great companies, created great wealth, created lots of jobs, and that are exciting companies to work for. If you think about kids graduating today, the companies they want to work for are not companies that were started 20, 30 years ago. There's companies that were started 5 years ago. So that's really pretty exciting, and I think it creates a lot of positive energy.
Others?
I think what I would add, my last company was a company called Big Machines, and which I started back in 2000, and it was kind of first generation cloud company. And starting in 2000, I started the tail end of the .com era, and actually remember raising our very first round for Big Machines still in .com days. And but kind of saw then multiple cycles as an entrepreneur, because then we kind of went through .com bubble bursting, 9/11, then a couple really tough lean years. And then obviously the market came back 07, 08, then it kind of tanked again, and then it came back. And ultimately, we wound up selling our company to Oracle last year and had a great outcome. But but as an entrepreneur, kind of saw all the ups and downs and valuations and capital. And I think after a while, I almost just start to ignore it. You really start just focusing on building your company. And when the opportunity is there, and I was very lucky, I think this year I've known Jason for a few years. And but then when the right capital is available, especially from someone you trust, And I was also lucky, you know, really, Jason was the only guy I talked to about SteelBrick, but if you know someone and you trust them, and you know, you also get the right partner, I think that to me is, you know, at least as important as any valuation. And then probably the other thing I learned from my prior experience, I think you always kind of want to run the company in a way where you're like, hey, if I can never raise another round, I'll still be okay. And I think that's through a combination of, A, you want to have enough capital on the balance sheet, and this year we raised over $10 million. But also, I think you want to run your company efficiently and lean, so that, you know, because I think these down cycles can always come, you never know when, but you know, you're like, hey, if I can't raise money again, I'll be fine, because we have enough revenue, and you know, you sort of have like a back of your mind pivot. If I have to build this organically, I know I can do it. And then I think you can always sleep well, and opportunistically, you know, if you do have the growth opportunity and the capital's there, you can take it. So.
Or you can just take the money when it's there.
Yeah.
So the question I think was about the business and cloud, and I think one of the most important things is to, in the Silicon Valley, we think about cool ideas and we think about smart people. At the end of the day, we got to start it with who's paying the bill. And the people that are paying the bills and funding our companies to start are the venture firms. At the end of the day, though, you got to get customers to pay the bills. So the question is, what is driving this kind of transformation in the way infrastructure or delivery of capabilities is occurring in the cloud? And fundamentally, it's pretty simple. It's just simple. And it makes it easier. I think the early Salesforce days were, hey, you should move all your Siebel Salesforce automation stuff into Salesforce.com. And the probability of that happening was 0. But it was, hey, what if you take 10 people and you try it? That's a very high probability hit rate. Pretty soon they start to realize that it's a simple thing to do, and then the next thing you know, the flywheel kicks in. So it's easy for them to do it, it's easy for them to pay for it, and then the rest of it just takes care of itself. And so I think when you're thinking about how this trend has emerged, it really is that it's just simple. It's really easy for you to bring up a service from a cloud-based perspective, pay monthly or annually, and do your business. And next thing you know, I mean, it's interesting, we looked at internally in our DevOps team, we started running AWS instances, and we were blown away at what the bill ended up becoming, just literally overnight, because it was easy to spin up a server and a server and a server. Next thing you know, we were paying millions of dollars from engineering resources in Amazon AWS. And that's a great business. Why did it happen? It was easy, it was simple, and it solved a problem. So again, focus on people that are going to pay you money and try to make their job and their life simple. I think it's simple.
Yeah, no, that's great.
The other thing, let me just add one other thing, because I think there's used to be a lot more friction in the conversation, especially with large companies, in terms of, you know, it's not my data center, I don't have control, what's the security issues, you know, what are the integration issues? We don't hear those questions being asked anymore. So there also was, not only is the value proposition clear, but the friction for actually implementing it and the trust factor is there.
Well, and it's interesting a point about that, because you know we would get those pushbacks, and I would say, well, remember the day when a fax wasn't a legal document, right? And now we're using DocuSign, and we're doing things legally that nobody. Oh no, I need to see the blue ink on the paper. It needs to show up in the mail. The post office needs to deliver it before I have a contract with you. Well, that's the great thing about Silicon Valley. There's interesting, simple problems that we just kind of make go away. We take the friction out of it. I think that's one of the things that if you focus on, one of my mentors, the guy that started Maxim Semiconductor, Jack Gifford, a long time ago said, go to your customer, find out what they're doing, allow them to do what they're doing more simply. And I think this is the kind of fundamental thread of what's happening in the companies that Byron showed, the 300 or so. I think that's fundamentally what they're doing, just making it easy.
So Kirk, unfortunately, certain governmental agencies haven't caught on to DocuSign yet, but hopefully that will happen.
They will.
So Byron, I was thinking we could maybe go back to the slide that you had on the various company overview. I thought that was really helpful. Yeah, this one's terrific. And I thought maybe Jason and you could talk a little bit about how each of you kind of organizes, obviously you've already done that, but how you've organized the cloud landscape for the audience. And in particular, are there certain sectors or buckets here where you're more focused and where you see more value in the long term?
Sure. So structurally, you see a lot of the answer here. We certainly parse it in a more granular level under the covers in terms of subsectors and internally what we call roadmaps in terms of investing themes that we're excited about, and continue to prosecute that. The good and bad is that the cloud secret's out, and so from the standpoint of an investor, whereas I think the benefit of being early in the categories as we both were, we had the opportunity of being among the few firms that actually could talk to entrepreneurs and to understand metrics and talk about MRR and those sorts of things, and sort of showing up was half the battle and finding the companies. At this point now, the public markets are aware, and that certainly rippled through to the broad cloud market, investors in the private side. And so we need to be, hopefully, a step ahead in terms of where it's going for entrepreneurs in the room. You're certainly thinking 2 steps ahead in terms of what are the problems of the customers that they're just starting to be exposed now, so that you can be out in front to solve those before the legacy incumbents and before it becomes obvious to competitors. And so, as I've said before, the SaaS category itself hit first, and so there continues to be a lot of opportunity there. In the main categories, we're seeing this ripple through internationally, which probably doesn't help a lot of the folks here in the room, but Western Europe and Asia are certainly embracing top-level business functionality. We're seeing more of this roll through to the SMB side, which traditionally distribution had been the burden for enterprise software. The unit economics just didn't hold up. And so you had the extremes. You had the Intuit, CD-ROM sitting at Fry's, or you had, the SAP sales rep, and there wasn't a lot in between. Now that with online marketing and on-demand, low-friction services, that bridge is being built, and you can certainly see growth vectors in SMB. The vertical side, which I'll let Jason talk to, it is a pot of gold there, and we just did our 10th investment in a vertical SaaS and industry SaaS opportunity, and believe that you'll see more and more category killers in those domains. And then in the platform infrastructure sides, it's earlier. I would note that for the most part, infrastructure as a service has a big red X through it for us as a firm. And it's not that there's an opportunity. There's fantastic opportunity there. What we see with AWS and Azure and Rackspace and Google and go down the list, awesome innovation. If you look at fundamentally the bet that Cloudera made, in between those two, huge fans of what they're doing. They raised $900 million at a $5 billion valuation. Was the public report. Just staggering bets that are being made in that space. We're a $4 billion firm, and we still get weak need at the magnitude of those bets. And so, in general, we're playing one level up, which is ride those rails. Absolutely huge fans of that enablement, but take advantage of that low-cost infrastructure, the forward pricing that those vendors are doing to beat each other up in a very good way of giving companies forward pricing, and then add services on top of that. And for us, that starts at the API layer, which is another growth opportunity, this business to developer opportunity. It's the Twilios and SendGrids and Crowdflowers. It's the DocuSign and Box platforms. It's the API interface that allows services on demand. We also think is a huge growth driver. Jason, you've got something?
Byron does a really nice job of laying out the landscape here, and I think for Emergence, this is very much, we also focus on kind of the top 2/3 for the first 10 years of the firm. I mean, we literally went through functional area by functional area exactly like this and tried to pick out the winners. I think today, if I were an entrepreneur, I'd probably, not that there's not continuing innovation in each of those functional areas, but there are leaders in each of those functional areas now that are multi-billion-dollar companies, and so it's a little harder to go up head-to-head against those. So where we have been spending more time is in the industry cloud, or his term is vertical, that's going after a specific industry and trying to go much deeper into the specific business processes of an industry and solve those most important problems for those providers. So to give you an example, Viva Systems was built on Force.com, so it's leveraging the cloud infrastructure, going after the life science industry. And in a very, very capital efficient manner. I think we invested $6 million in that business. They were able to scale that to I think about a $300 million run rate business today, and never raised any additional capital. That's pretty rare for a company that's doing a horizontal functional type opportunity. And the reason was it's highly referred segment. So as soon as you have customers that are pharma companies that are up and running and happy, it's much easier to get the next one. The second thing is pharma companies write big checks, which is really nice. And the nice thing about the industry cloud model is it's very much a land and expand model. And so where they started with one product, they now have 4 products, and so they're able to kind of sell more into an existing customer base, which, if you understand the SaaS model, that's one of the most cost-effective strategies, is to sell more into your existing base. It also creates more lock-in, so there's just all sorts of good stuff that happens with that. So industry cloud is an area that I would be spending more time on if I were an entrepreneur. Mobile first is also an area where we feel similar to how SaaS and cloud disrupted the enterprise software space, mobile first applications in a lot of ways are going to disrupt SaaS and cloud. And I think, and I was an investor in Yammer, I love Yammer, but using Yammer on my phone is actually quite challenging. So, and it's amazing, it's not an old company, right? So Microsoft bought them, and my sense is that some of the innovation there is slow, so there's opportunities for new teams who are taking a mobile first perspective and making your business run on your phone is how I would think about it. Those are going to be huge opportunities. And then the third is the spaces in between the functional areas. And I think this is where Godard plays, for instance, in between sales and finance, for instance. And so there's a lot of deep functionality between the functions that I don't think have been fully taken advantage of. So it's that now that you have individual cloud leaders in each of these functional areas, how do you bring those two together and create more value going deep in between those crevices, so to speak. And those are deep wells of opportunity.
That last point's an important thread, not to hijack the question, but maybe if Vic and Godard could just give a little more color in terms of what your companies do, because I think neither of your businesses would have been possible 6 years ago in the way you're doing it. And so in terms of this idea of staying 2 steps ahead, because there's now enabling technologies in place with marketing automation, CRM, different finance tools, now you're able to see, okay, connect the dots, what will the pain points be in the new architectures? And that's where you're able to still, to Jason's point, disrupt within sales, marketing, finance categories, but in a very different way.
Yeah, I mean, our company, Infer, you wouldn't be able to build it, even 5 years ago, I'd say. And it's actually hitting on, what Kirk mentioned. I mean, simplicity gave rise to a variety of fantastic platforms like, Salesforce and Marketo and Eloqua. Companies wanted to store their sales and marketing data in the cloud, and what that did is it basically created some standardization around the data. Right? It meant that companies were no longer storing that data in their spreadsheets or behind the firewall software, and our ability to access that data would be incredibly limited, or we'd have to do a lot of consulting to be able to go behind those firewalls to get the data. Everything was in the cloud, so it meant we could also build a cloud service to be able to access that data. And I think in addition to simplicity, there's another trend that's kind of emerged, which is just the capabilities of what we can do with infrastructure. We are able to do predictive modeling and data science at scale, things that Google, I think, really kind of introduced into the market. But when you start to apply those into new areas, such as sales and marketing, where really no one was being very data-driven or predictive about that workflow, combining that with the fact that the data was finally available in the cloud and you can access it and standardize, you can do some wonderful things when you put those two together. And then the other trend that we kind of jumped on, which is just the general web. There's a lot more data about individuals and companies online than there were before. So one of the tricks that we do is we not only look at the company data that a company has about their customers and their sales and marketing automation systems, but we also combine that with data that's available about those businesses and those customers that are online, because there's so much more data. You can look at Twitter and see kind of the things that they're saying, their conversations with others and their own customers. You can see what kind of products they're using. You can crawl their website. You can see technologies that they're using. There's so many signals you can collect, and so you really couldn't do this company 5 years before. And in terms of kind of where we fit, we appreciate being included in the marketing section, which is awesome. But we really sit between marketing and sales. We're kind of in that in-between space because there's this arbitrary division between marketing and sales from a technology staff perspective, and a lot of it's just political, but it creates a lot of problems. You can't really do full circle reporting. There's data gaps between the marketing system and the sales system, and so forth and so forth. And so what we do is we connect to the CRM system, the sales system, which has all the ground truth of what deals you closed, what customers you closed with, what customers you lost. And we also connect with the marketing automation system because that's kind of the gatekeeper. That's the top of the funnel. Those are your prospects, your potential customers are coming through that system. and when you connect the two together. So a lot of the the innovation and the value add we provide to a customer is just simply blurring the gap and bridging the gap and closing the loop between sales and marketing better using kind of our science of predicting customers. Because that's a useful primitive for both sales and marketing. They can align towards that metric to grow their business. And obviously we're biased too. We love the sales and marketing areas here. And I would say it's kind of been a consistent theme with other investments that we've seen, just because it goes into the path of revenue. It's a top line argument. It's not like if you're fortunate and you can get great traction with a Yammer where you're helping with productivity or you're doing something in the email space or something like that. The sell there is very different than for us, which is, hey, we're going to grow your revenue and here's how we do it. And you may like us or not, but you probably want more revenue, and it's not something that you kind of can push off. It's not a cost savings argument. So I think there's a lot more action and activity there, especially since that space hasn't been touched by data science yet.
And for SteelBrick, and I mentioned earlier, we're a next generation CPQ company, and as I mentioned, I'd actually built kind of a Cloud 1.0 company in the category. And actually our slogan, kind of Kirk, what you said, is CPQ made simple. Because in building our last company, what we found was too difficult was, because we had our own cloud, it was quite complex to deploy. And so while it was a lot simpler than Oracle or SAP, it still, would take many months to go live. And now with SteelBrick, actually Cloudera, we were able to take you guys live in 2 weeks. And it was by taking advantage of a lot of the enabling stack. Because how SteelBrick is different, we actually built on top of Salesforce's cloud infrastructure. And also took advantage of the fact that now most companies, especially in high tech, our primary vertical, they've all implemented Salesforce. They already have their customer data there. They tend to have their products there, their pricing there. And so we can take advantage, A, the infrastructure, it's already there, B, the data is already there. And so we really just add a layer of application logic on top of that then allows companies to very simply and quickly deploy coding functionality. And I think the other dimension where we're taking advantage of next generation, certainly we see mobile as a big new frontier. All of our users tend to be either salespeople or potentially customers that are buying a product. And the way SteelBrick works is maybe a little bit like when I hate to use Dell's website, but the best known example of kind of CPQ where you go configure a PC, you take a laptop, a model, memory, hard drive, it guides you through that process, making sure that you as a customer find the best solution for you. And we really help people do the same thing, but we also think mobile is going to be the next generation interface for that. And so we're also one of the first companies in our category to support Salesforce One Mobile as a starting point, but we really see us, ultimately the user interface is going to be mobile, and then we can bridge that back to the cloud infrastructure that people like Salesforce have already built. And those are all things that certainly didn't really exist a few years ago, so it's exciting to be able to take advantage of all of that and make it simple for our customers to take advantage.
That's great. Kirk, any thoughts on this cloud landscape here?
Yeah, I think it's the horses are out of the barn, right? This is the way people are deploying. What's interesting to me, and if you talk to some of the larger, more successful, the Salesforces, the Workdays, et cetera, that are kind of categorically here, what's interesting, we're about he who owns the data controls the world. And in some respects, Cloudera doesn't really care what the data is, whether it's HR data, Salesforce data, servicing, or customer data, it doesn't matter. And at the end of the day, the question is, in a traditional data center of years past, all the applications resided in one place. So arguably, the CIO or any line of business could theoretically, it was never possible before, but theoretically get a cross-section of marketing data, sales data, finance data, et cetera. Well, we know that never really happened. Today, what we've done is we've enabled more vertical applications and also solutions. The question is how do those cross-pollinate one another? For example, how do I take when Salesforce moved into Supportforce, that was taking a customer buying experience and blending it with a customer use or how they were using your product. Now you have all these many more wrinkles like marketing automation in it with Infer. It's an amazing product. SteelBrick, which is the quoting, we use these guys a lot. The question is where the data resides, who controls it? So for example, if you're Mark Benioff, are you controlling the world because everybody has to come to you to tap the data that sits there? If you're Anil Bhusri and you own your Workday as the platform and are driving everybody there, does the enterprise of the future become those platform providers where the data resides there? So you've just moved the center of gravity from a data center to somebody's cloud, Google, Amazon, whatever. So it's an interesting question as to, as these different solutions come up and that data, where does that data reside? So who really has the power overall? And I think that's one of the fascinating things in the future that we're going to see, because I will tell you, Salesforce wants more data to reside there, Workday wants more data to reside there. So with all these entrepreneurs that are building new companies, are they offering the value because they're pulling data out and giving you a unique solution, or does Salesforce own you because they own your data? And I think this is one of the kind of compelling things to think about.
That's a good question. Okay, great. So I think we've covered now the market landscape. We've covered kind of where we are in conditions. So let's take a couple quick questions on those topics. Anything? Sure, right there.
Yeah, $2.5 trillion industry, data intensive, known as healthcare. Seems to be, I can't really see the chart too well, it's like an eye chart, but it doesn't seem to be up there anywhere. I was wondering.
Yeah, it's in the verticals.
Okay, can you guys talk a little bit about what you've seen there that's successful and what you'd like to see more of, or something new?
So successes and opportunities in healthcare. Jason, you probably have one.
Yeah, so we're big fans of healthcare as an opportunity in the vertical strategy. We've invested in at least 4 vertical solutions going after healthcare. Healthcare has been challenging historically just because the systems are archaic and the regulatory environment is hard in terms of sharing data. But we are starting to see things open up for the first time, and quite, you know, one of the interesting things with cloud and mobile is that you can attack the users of technology directly as opposed to going through the CIO and having it pushed down, and that's kind of opened up the playing field a little bit. To give you one example, we have a company called Doximity that is basically a mobile LinkedIn for physicians. It allows them to connect with other physicians in their areas of specialties, communicate between them on various cases, do searches if they're looking for jobs in a specific area. This is a mobile app that you can any physician can download, and 50% of all physicians in the US have now downloaded Doximity and are using it. That's unprecedented. It's absolutely unprecedented for even the largest healthcare providers, IT providers today. So there's some new interesting twists to kind of break through in terms of the distribution possibilities that I think open up healthcare. And clearly the size of the market is incredibly attractive. And a lot of the innovation and disruption that's occurring on the regulatory frameworks, Obamacare and others, is creating opportunities. So I'm a huge fan. It does require more domain expertise and a certain set of relationships. And we're trying to build that up in our firm, but we've now got probably 6 healthcare-related opportunities.
Yeah, I could also tell you that from my perspective of having done enterprise software companies and whatnot for years, healthcare was always probably, you know, at the bottom of the stack of top 10 markets you would go into, because most of the innovation was spent on research and or, you know, medical delivery kinds of technologies, you know, better MRI technology, et cetera. Because of what's going on relative to the cost of health worldwide, there is a much sharper focus on things like population health. There's a lot of companies that are doing things with big data. They're analyzing the probability that if you have a certain kind of a knee replacement, will you outlive your knee? And this is the matter of either having a profitable business or losing a ton of money. Because the traditional thesis in healthcare is serve the patient, don't worry about the cost. And I think that's a great kind of ethos. At the end of the day, if you can actually serve the patient well and make money, what's wrong with that? And I think we're in a zone now where tools like what Jason talked about are capable, where we have them now, so we can actually solve both of those problems. We've seen an incredible uptick in the use of technology from our perspective in analyzing customer data, insurance data, public data that's out in the public domain. It's been a very, very interesting transition in the last 2 years. So I think it's an exciting area.
Great. Okay. Yes. Quickly.
So I have a question. When I look at this chart, I still feel like it is laid out in the format of a typical kind of enterprise business, but in hearing everything that was said by the panelists, particularly by Vic and right now, what I see missing is how cloud, and although we're seeing examples of that in real life, cloud is playing a role in merging consumers with enterprise and really using the data to both support businesses serving consumers, but also to providing consumers access to their own data. And how will that data work? And also, how does that change the dynamics of just the way we define enterprise businesses versus consumers? So,
Question on the consumer angle here, I guess.
Well, I mean, it's happening in healthcare, right? Your ability to access and have communications with your doctor, first of all, by email, and then be able to, depending on where you get your healthcare, get access to your medical records. I mean, I think it's a massive transformation, and one that has, it's wrapped with all sorts of challenges. We talked about legal security issues, so we're overcoming those. And so I think that is one very good example of where kind of the B2B and the B2C piece is merging.
Yeah, and this is obviously oriented functionally by economic buyer. You could add multiple axes on this theoretically in terms of business model. There's a freemium element here, which for a B2B environment is often thought of as that bridge where, you know, a Box or a Dropbox free account, onboarding, or DocuSign's free account onboarding, those sorts of things to pull you in, where the person, you use the product at home, you use it at work, and your IT department buys it because they want to have some controls and some admin over how you use it at work. Everyone wins. There's obviously an entirely different dimension of a Yelp or the consumer side of LinkedIn, where there's a valuable business proposition there, but it's a multi-legged stool, and that the consumer community and the consumer subscriptions and the consumer engagement drive a meaningful portion of the business model. However, they also monetize through a B2B buyer. And so these are all subjective in terms of where you draw the lines. We took a decidedly B2B view on this, and so we've kept off the Yelps, but included the LinkedIns, because LinkedIn is, again, 80% enterprise. But certainly many people have drawn similar visuals in different ways, and I think they're equally credible in many cases.
Okay, actually, why don't we pause on questions right now, and then we'll come back to that later. So I think we've addressed now the market. Let's now jump to, I think, the other topic we wanted to really cover, which is the elephant in the room, and that is the laws of physics. I understand still apply in these markets, and things that are going very high up may sometimes come back down. And so I'm trying to understand from the panel, what do we think about that? Byron, how close are we? Does it feel more like 97 to you? Does it feel more like February 15th of 2000? Or what's your best guess on that, and where do we think this is heading?
I have no idea. I mean, if I did, I'd be a hedge fund investor, right? Clearly. We're optimists by nature, and so we feel we have conviction on our long-term trends. We believe, as an industry, this is still going up. We believe that, as many people have commented on, the fundamentals of these businesses are real. Growth rates are real. The business model leverage is real. The category definition is real. Many of the 300 and the unicorns and many of the emerging businesses will be multi-billion-dollar public companies if you fast forward 5 to 10 years. And so, as investors, we are hesitant to sit the cycle out, and therefore we're trying to be selective. In the later stage rounds, we're paying market prices for the companies that we think can absolutely be category killers, and then we're going earlier stage and rolling up our sleeves. And as many people have commented, sort of ignore the cycles, think long term, and good things generally happen. However, from an entrepreneur's perspective, where you do have specific funding events and milestones along the way, it's very clear the getting's good right now. And take your farming analogies of get when the getting's good, or sports analogies, or whatever, but it's raining money out there. And if you anticipate either selling your business in the coming year or two, or if you anticipate needing to finance, then round up or round earlier, or however you think of it. Don't get too cute in trying to optimize, because I think on balance the investing community would take the under, not the over, in terms of where multiples go. And it's not a bad thing on the space. It's just that there will be some compression, and great businesses will grow through it and still build value, and everyone wins. But if you overthink it and we hit any bump at all, valuations will certainly come down, and it could get worse than that, where investing freezes up.
How about the others? How worried are you guys? Oh, anyone? Jason?
As an HBS grad, I can use this statistic, but the leading indicator of when we're at the peak is when the percentage of graduates at Harvard Business School are joining that particular industry. So, and I would say, if you ask today, the vast majority are either starting companies or going into venture capital. So we're pretty close to a peak, in my opinion. That being said, that doesn't worry me. It doesn't worry me. It's probably harder to start a company in this environment in some ways than it is when it's tougher, because I think you don't have a lot of the same discipline that you do when you're starting in a tougher environment where capital is scarce and you have the right mentality. And but it's also, for frankly entrepreneurs who have been through it before, this is an amazing time, because you got guys like Godard who've actually seen it already, who are now raising capital and they're taking advantage of the environment, but they're not getting lost in it. They're not believing or drinking the Kool-Aid to a point where they think it's going to last forever, because it won't last forever. Is this a great time to be an entrepreneur? One of the best. You've got seed and angel investment at an all-time high. You've got venture capitalists, like running over each other to invest in great companies. You've got public markets that are open and available. And we've got late-stage markets today, by the way, that are unprecedented in my experience, where you've got public market folks coming down and doing private rounds at multi-billion-dollar valuations that by historical standards would have been, huge IPOs. But these companies have the advantage of staying private longer and continuing to invest aggressively and not tell their competition what's going on and keep hiring. One of the challenges with being a public company at very high-value stock price is how do you recruit the best employees at that point? Right, so a lot of the energy and kind of pent-up opportunity is built when you're a private company. So I think not only is it easier to start, but it's easier to scale today than it's ever been. So I can't imagine a better time. And to speak personally, I love working with guys who've done it before too, and appreciate that. Don't take it for granted.
Yeah, Godard and Vic, you guys are living through this right now. How's it felt to you? You've just raised financing rounds yourself.
And I guess I'd say day to day, really, I guess maybe I just, I don't really feel the financing, because I think what I'm stressed about is customers and product, and, so I don't think about it that much, to be honest. But I do think it's a great time. Frankly, also as an entrepreneur, sometimes a downturn is a good thing, because I remember, like 08, 09, if your company's in a good spot and you have a downturn, it can actually be very beneficial, because it's easier, to hire people, and all the inputs actually get less expensive. And not that I'm rooting for one, but but at some point you're probably going to live through that. And but I think it's a great time. And more what I'm excited about is, like everyone was saying, right, the enabling platforms, mobile, cloud. It just makes it easier for businesses to do this stuff. So I think that's what gets me excited. I think just a lot of companies can use our help. And this technology is still complicated, so making it simple for businesses to do cloud and mobile well, I think that's exciting.
Victor?
I would just say I think there's limited correlation between great entrepreneurial ideas and macroeconomic trends. And so, I think Byron mentioned this, that, great ideas are going to continue to be formed even in the worst of times. Great entrepreneurs are going to build great companies. I actually agree with what you just said regarding opportunity. When the market is peaking, like right now, people are going to companies where they're being paid outrageous amounts of money, and interestingly enough, public companies, that's all they have, right? And then private companies get these high valuations, so I might as well go make more money at Google than go to a startup where the valuation's already too high. So it becomes a very confusing environment. I think the question really is when to raise and how much to raise. And I think that's constantly a question. So the only reason you would change your trajectory is if you anticipate that, as Byron said, you have some event coming up. Gee, should we raise money now? Should we raise more? But other than that, I don't think it changes one thing relative to an entrepreneurial economy or spirit or company starting.
Okay, Kirk, so 900 million. Most of the entrepreneurs here would love to have an exit at 900 million. You guys raised that much, so you have to explain to the group why, in the context of what you just said. I suspect that's more than 1 year of runway for you.
Yeah, slightly, yeah. Well, it's interesting because it has changed the outlook for us. An IPO for us wouldn't be a financing event, right? It would be something different. What really occurred there, and frankly, it was that we were making so much progress in this next new big wave. Intel looked at open source Linux as the first big wave they participated in, then virtualization. They see big data as many times bigger than those previous. Their view was they needed to be into the market. It was one of those rare kind of hand-in-glove partnerships that occurred, where they wanted Intel Silicon to run Hadoop workloads better than any other silicon. So they knew they needed to be in the market. They wanted to be with the leader. They wanted a seat at the table. So that really drove the partnership, and then price and value was just driven on their desire to be a part of it. So we were in a very good position, being the leader, to command a high price and a high value. But I will say that the partnership is an amazing one. In 25 years of doing this, rarely do you see a partnership that is so hand in glove, where what they do and what we do are 100% complementary. Usually there's overlap. Usually there's a little bit of tension. Usually one partner wants more than the other. So it was a lightning strike, I guess is the best way to say it. And timing worked out well. So we were fortunate. We feel very fortunate to have Intel as a significant partner and Kim Stevenson as a board member. So.
Just one other data point I'd like to add is these are average numbers here, but if you disaggregate them, the highest multiple companies are the ones that are growing fastest. So, and I think rule of thumb, for every additional 20% of annual growth, you can double the multiple of the business. So essentially you're getting paid to grow faster in this environment. Now there's constraints to that in terms of culture, in terms of hiring good people, in terms of making sure customers are happy and satisfied and will stay with you. But our perspective is capital is cheap, and right now if you can grow faster and you cannot break things as you go, you're getting paid for that in the market today.
Okay, so when you raise this much capital as an entrepreneur, I think one of the thought processes, and the entrepreneur should tell me this if you agree, is, well, to compete, I've got to spend it, right? And so, is cash burn too high, guys? I mean, what do you think? Where are we in terms of your companies, your portfolio companies? Are companies spending too much right now?
I would just to say, listen, the one with $900 million in the bank. The thing is, it's funny and it's fun. It creates a long-term perspective, but I don't think there's anything that we would do differently. You said it exactly right, which is there are constraints to your growth, and if you raise $5 million or $50 million or $100 million, it really shouldn't change the trajectory of your business, because you can only hire and assimilate enough engineers. You can only then turn them into product builders for a certain amount of products. You can only serve so many markets and customers. So I think it creates a security perspective from your business. It allows you to weather a few things, but boy, in some respects, and I think a lot of the venture capital, one of the kind of the little themes there is you don't want your startup to look like a bank. Because if it does, you start getting comfortable, you got a bunch of cash, you don't have to raise money, you don't have to worry, we had a product slip, don't worry about that. You lose your intensity. So if raising money causes you to lose your intensity, don't take the money. Run a lean organization. And if you take the money, forget that you took the money and run the business as you would ordinarily do it. So I don't think it shouldn't change anything.
So what percentage of companies do you think have that discipline, I guess is the question.
And this is where I would actually, it's interesting, this is where, I would actually give a lot of credit to a good venture partner, is that they're the ones that have seen a lot of these ups and downs. A guy like you that's been in the business a long time, they'll help you understand that the money in the bank is there for the rainy day, but it doesn't change anything with respect to what you should be doing operationally. So I think that's where good advisors, people that have been there and done it, maybe a guy that's seen the 2000 and 2008 cycle, I think it really helps you quite a bit. But you're right, the discipline is the issue.
We were in a board meeting yesterday joking that, remember when people gave away Z3s with every employee referral back in 2000? It's almost getting that bad in the city right now, hiring. And so it certainly is scary in terms of just some of the escalation of costs and those things. With that said, maybe to be a little provocative, you have instrumentation in cloud businesses, at least at some scale, that you've never had before in the enterprise world. And you can actually look at the inputs and the unit economics and understand the customer acquisition cost to lifetime value ratios, the marginal returns, the demand gen side with online marketing, the efficacy there. And I would argue that it's irresponsible not to grow at the efficient frontier, and you're leaving opportunity on the table and that the barrier should be human resources. To Kirk's point, it should absolutely be the bandwidth that your exec team and your operational team can absorb, not the capital inputs. Cost of capital right now is pretty cheap for any business that's really working. What you need to do is understand the instrumentation so you can make the case to fund the business to grow at the maximum rate that you can, because you will be rewarded for it, not only in terms of short-term valuations, and certainly there's a premium for growth rate, but more importantly in terms of category kingsmanship. If you want to win the space, guerrilla economics applies. Disproportionate profit accrues to the winner. And frankly, that's why we're all playing the game, is to build something meaningful and have impact. And so where you have a model, where you have the luxury of scaling, where you actually have some things that are working, both feet on the gas.
I think it's important also, and most folks know this, but it's important to reemphasize it, that as investors, we do have a portfolio, right? So, and we're also paid, and we earn a lot of money when we have a few companies generate really outsized returns. And so there is a natural bias for us to be, pushing you guys to grow fast. So as disciplined as I hope I am, you got to understand that there is a natural bias from any investor to push you guys to be on that efficient frontier. And fortunately, Byron's had enough success. I've had enough success that we don't need every company to be that outsized return. But you got to recognize that there may be some younger folks in the business, for instance, that are trying to build a track record or are feeling pressure in their partnerships, and they're going to push you hard. So you got to be the master of your own destiny, I guess is my ultimate point. You're going to be getting a lot of inputs from different investors, from your peers, and just be ready to take responsibility for making the call. Never abdicate that decision.
So maybe Vic, if you could take this one, which is you guys raised money a little while ago, but in this environment, given maybe you don't need the cash, is this something that you're now trying to think about very seriously? Is it basically for entrepreneurs, should they be thinking about kind of pulling in financings earlier than they may otherwise actually need in order to take advantage of the current timing and maybe to avoid issues if there's a pullback?
Yeah, I mean, it's kind of hitting on what Kirk mentioned. I mean, when the market was it's kind of crazy right now, and there's loony valuations, and we were and we still are very heads down, and we were kind of oblivious to it. We were just building our business, and then you just start getting pinged by everybody in the investment community, and then your board starts telling you that there's great money out there, and I think for us and the way we think about it, I think it goes back to kind of your discipline. Is what's your plan? What kind of company are you trying to build? And do you have the goods to be able to scale? What's your 2-year plan? And there's actually a really good exercise for us to kind of think about. Now that we have actual numbers to work with, we've been out in the field. We know kind of we have some variables that will change over time, but we have some numbers that we can work with. We can kind of build out an actual model of what kind of company we can build. When can we hire how many folks and what departments and everything else, and under assumptions that we think are reasonable. And where does that take us in terms of a business? And is that the kind of company that we want to build? And I think you get alignment with your board and your team behind that, and you march towards that. And I think it makes it easier, kind of starting from that point of view, to determine where cash can be helpful. There's the other aspect of it, which is more of an insurance policy of having cash, if you can get it for cheap, and having it there for a rainy day. And I think that's fair. But I think having a disciplined approach of how you want to build the business, irrespective of that, is also important. So that way you can line up the expectations properly, especially with new investors, so that they agree to your marching orders versus maybe trying to press harder or press slower, maybe even because of the cash that you put in. And so I think in this market, assuming you have that plan, kind of where cash can be helpful. I think the next thing you got to think about is I want to make sure everybody on our team, as well as our investors and our new investors, they get a win in the next round. And so you can really over-optimize these valuations to the point where it could be hard to grow it, especially if your plan doesn't feel it lines up with those valuations. And the fundamentals will change, kind of what Byron was mentioning. Right now, these are the multiples, but in a year or two from now, it might be different. So I think in that case, if you are going to raise, and you are going to raise a fairly high valuation and get it for cheap, maybe the better option is just to raise a lot more cash. So that way you have more optionality to be able to grow the business the way you want and hit that valuation irrespective of the fundamentals at that time, and give everyone a win going into next round, and thinking long term about it. I think the earlier point around cash burn and is it high? For us, we've been fairly cash efficient, and because there's just certain constraints you have. For the longest time, until literally like a quarter ago, we had one person managing all of our customers, and it just got so crazy. That's from a post-sale perspective. So like, we put gasoline on the sales side, you're getting churn on the other end, so you kind of have to make things work in lockstep. We put more people there now, so we're good. So now we can put some more gas on the sales side, and we're seeing those returns. But you have to be smart about it too. It's not just about throwing money into it and seeing what happens. You have to kind of follow instincts and follow best practices in growing the company. But we've been fairly lean. We raised $10 million last year. We're sitting on pretty much most of it today, so we're not in a position where we have to raise. But kind of talking to other companies, and especially younger founders, there seems to be a very high cash burn, and there's these SaaS founder groups, and they're almost like these elite clubs where you have to have a certain ARR to be a part of the club. And I didn't even know about these things. They're more in the city than down here, and our company's down here, so we're more chill about it. But I think up there's definitely things like you have to have at least 2 million ARR to be a part of these groups and whatnot. And there's some good networking opportunities out of this, so we joined it. And I started talking to some of these folks and kind of hearing more about their business. And one of the companies we talked to, based in the city, is they're doing about 2 million ARR. They just raised a seed round, and I'm like, oh, that's fantastic. And so we started talking more and more. And they have 20,000 square feet in San Francisco. They have 70 employees, more than half of which are in sales. And if you look at their price point, they're going after very, very small companies. So in terms of their market, so a lot of variance there. But these deals are typically like 2 to 3K, and there's a pretty decent churn in the first, second, third month. So they don't have enough to really pay the reps. So then we started talking more, and then realized the company's gonna run out of money in 3 months. And
those guys will be going to business school soon.
But I think there's also this, you have to be disciplined. You can't, the Valley, there's these, it's a very fashion-driven industry, and people start to optimize towards these metrics, like I'm gonna go and I'm gonna hit this kind of ARR. You can hit those ARRs, but you have to do it in a way that makes sense. And I think, and I think companies, and when they compete with each other and then they define each other as by revenue, then it's like this competition, and you can do things to accelerate and hit those points, but it's very dangerous. And so for them, they're in a tough situation, and he doesn't even realize it, which is the crazy part. And so so I think that part is the concern. And it's kind of like Bill Gurley came out, he was in a piece and he was talking about how he thinks cash burn is through the roof. It's crazy. And so I don't think it's just that case. I think there's a lot of companies doing that. So I think the discipline and making sure others are following that, I think is not easy. You just have to think about it on your own, for your own company, to be smart about it and not follow the fashions of the market. You got to go with what you think is best for your company and your vision, what kind of company you can build, not just what a company you can build or someone else can build, or maybe Larry Ellison can build. You got to do it your way.
So Vic, you're using them as lead gen for new employees? A recruiting mechanism?
I think to be honest,
you're very ahead of the group.
I think for that company, we probably would avoid some of that talent, just because when we were going up the elevator, the folks in the elevator who were part of that company, they were talking about how they raised money from like Chum Millionaire. And they're thinking about adding Joe Montana to the round, and it's like, oh, you gotta add Joe Montana. I was so surprised, because I'm like, oh man, all the stuff in HBO's Silicon Valley is actually correct, and I didn't think any of it was. So it is what it is.
That's good. Godard, any thoughts on that in terms of?
No, I think Vic said a lot of it well. But I agree, you need to have a plan, and that's actually one of the first things we did work out with Jason. We do have a 5-year plan, but I think the Soviets proved how well 5-year plans work. So I'm sure our plan will be wrong, hopefully on the upside, but you can't you're not gonna, it's a startup, you're not gonna plan well, but I think it's good to have a plan. And I think as an entrepreneur, probably the gating factor to me, and right now it's not capital and it's not market. And I think Kirk, you said it's people. And because we just went, the company, SteelBrick, in January, we had 5 employees. Now we have almost 50. And kind of before we go to the next wave, I think the key thing, we went from 2 sales reps to 10 sales reps just in the last 2 or 3 months. So obviously what's pacing it now is, the hard thing is how to get everyone up to speed, how to get everyone productive, how to get the knowledge transferred, and obviously building processes, systems to make that easier. And that's true across the board. Also our development team is going from 2 to 10 developers. And then I think the gating factor is always, those next people you've hired, do they have the knowledge, are they fully productive? And that then I think becomes a gating factor, and I want to have kind of also the feel that, hey, they're all productive, right? And all 50 people are productive before you kind of go to the next phase. And I think that's what will always be the constraint is getting the people, making sure they're productive before we hire the next batch.
I wanted to bring up 2 quick points on this systemic risk question, which is different than 2000 to me. The first is, most of these businesses are recurring revenue business models. And back in the 2000s, it was .coms, e-commerce. So these businesses have a lot more reliability. And secondly, those customers are not other startups typically. They're now real companies. So the level of systematic risk in the whole ecosystem is a lot less than it was in 2000. So I think if we do have a pullback, and we will, from a market perspective, you can tamp down on the growth. And these companies will start to throw cash. I mean, SuccessFactors, when we took it public, looked really ugly from a P&L perspective. And then when we had the downturn, we pulled back on sales and marketing, and the thing just started throwing cash off. And then when the market came back, we started investing more aggressively. So you have that ability to kind of pull back and push on the gas, push on the brake in a way that you didn't have, I think, back then. So that gives me a little more confidence to make some of those investments and those bets for growth.
Okay, so last topic. What is there? There's a lot of people here in the audience, I think, who are very much trying to figure out what to do. Any advice on, area, verticals? What is lacking in innovation right now? What you guys are seeing? Anything you can provide to the audience in terms of guidance along those lines? Any thoughts?
Well, I guess mine from the entrepreneur's perspective would be less about which market, top down. I think it's more bottoms up. Like, what do you uniquely know well? Especially I think if you're doing business and enterprise, I mean, the nice thing is, I think, well, to me the nice thing is, like, it's probably not gonna be a 22-year-old out of school. It's not gonna be your competition, right? So you can use your advantage. Maybe it's because I'm older, I'm 43 now. But I figure my advantage is I've actually, I know something about, businesses, high-tech businesses, how they run, what they need. And I think using that, right, where you have some unique domain or technical expertise and work with that, because I think the one downside is a great environment for entrepreneurs. I think also there's more companies being started than ever, and there's more noise. And so I think for anyone starting now, it's how do you break through? And I think it's got to be something you really know and obviously you're really passionate about, and use that versus trying to think, hey, top down, what seems exciting.
Great. So Jason, every area has a big player, you were saying, but is there any way that startups can kind of get an advantage here? Anything that they should try to think about?
I'm in this business because I just think that there's constant innovation and disruption, and it does come. It's the passion of the entrepreneur that I bet on. I see ideas every day that excite me. So there's no lack of great opportunities and ideas. I think execution is the hard part. So, picking the right co-founders, structuring the partnership with your capital providers in the right way that leads to long-term success, and then having, I think, something that's maybe bigger than just making money. I think having a purpose matters, especially for younger folks who have lots of options today. They want to join a team that is trying to change the world in some way. So I think having a bigger idea about the impact that if you're successful, you can have on the world is a really important part of the equation.
Good. All right. Questions? Yes. Right there. Yes.
Previously, it was discussed about the Series A's are getting larger, but also the criteria is very high. Well documented, there's been a Series A crunch. Can you talk about what you're seeing from early stage startups in terms of trends on how they're financing pre-Series A, what type of milestones you're looking at as they approach the Series A? cetera.
So metrics for pre and up to a Series A, kind of what are you looking at right now?
So we focus mostly on Series A, and our actually criteria hasn't changed that much. I think the market has changed a little bit in terms of availability of capital at the seed stage, and then the ability to leverage the cloud in a way that you can get to market with a lot less capital. So in some ways, we're having to take less risk because there's really good early customer validation when we're making that initial investment. In this environment, it seems like everybody's kind of moving a little earlier, like 1/2 stage earlier than they typically would ideally like, just because I think people tend to want to take, rather than taking less ownership, they'd rather take a little bit more risk and write a slightly larger check. And so, but I think the key is making sure that you're aligning the capital that you're getting with people who are comfortable with the stage of your business and have experience in scaling that business to the next stage. And one challenge, I think, is now some companies are being overcapitalized, very, very early on with not folks who are, they're more hobbyists than institutional investors. And frankly, those guys may not be there for the company long term if we do have a downturn. So the other thing I'm seeing a lot is the seed investing by institutions. And I've never really been a huge fan of that, to be honest with you. I think it sends some negative signaling if you don't end up becoming an investor in the company in the next institutional round, and it's almost a constraint from an entrepreneur's perspective in terms of who they can work with going forward. So kind of like have an entrepreneur have the optionality. There's plenty of capital out there. You can get to market with a product, but not a lot of capital. So prove that there's customer validation and you're solving a real pain point, and then go find the best capital provider you can to scale the business.
Yeah, just the only thoughts to add, the convertible note structure for seed rounds is still quite popular. And I would say don't take advantage of your friends and family in those situations. I mean, by definition, these are people that are betting on you. And so, we've seen cases where people have raised massive rounds or done uncapped or huge numbers or whatever. I think Vic made the point that you want to set it up where at each stage it can be a success for those investors, and you don't sort of price yourself out of smart money downstream. And so, convertible notes with caps, they're clean, they're easy, they're good. Certainly, they're readily available in terms of capital sources, and so that it makes a lot of sense now. And then I think the reason why people are saying the hurdle's been raised for the A is just that it's so easy to get started now. It's so cheap to get product in market, get initial customers, online marketing, et cetera, and you can raise the $1 million seed round among entrepreneurs at Bucks or at on University Avenue. That you should be able to have customers and traction, and that's now a realistic hurdle. When I started my business in 2000. It took us $10 million just to get product in market. We had to stand up, Unix boxes and buy Oracle licenses, and spend a year in building out our data center infrastructure and team and all that to get product. Now, with $1 million, you should be able to blow past everything we did for 10x that.
I think the other thing that maybe the emotional side of this is you look at these two gentlemen here that have done it twice now. Is that right? And I think there's something to be said for who you pick to be your investor in your A round, because just like you pick your founders, you decide whether you can get along together, you can see a long-term horizon. Not that the B, C, D growth investors aren't also important, but I think who you partner with right in the beginning has a very significant material effect on what happens afterwards. So for example, a lot of people will go to certain firms and say, well, I'm a mobile company, this is a mobile firm. I'm a big believer you hire and fire your boss. So the firm or the company, I think, is important but secondary. So I would look very hard at the individual. Of course, you want an individual in the right kind of a firm, but I would look very hard at the individual that you're going to spend the next 10 years with. I think it's oftentimes underestimated how important that part of the decision is.
Yeah.
Yeah, let's take you down to the bowels of the data center right now. We talked about really great growth, right? And all this cloud infrastructure is based on 50, 60-year-old technology, meaning tape drives, disk drives, right? And disk drives run out of steam. Do you guys have any thoughts? Is this a problem? Yes, I'm looking 2 years down, and I'm 2 steps ahead of you. But have we looked at this, that disk drives can no longer scale to Moore's Law, they're 20%, data growth is 45%. We know that SSDs are coming on strong for fast transactions, what's happened with the warm data? What's going on with that?
Listen,
Are you guys interested in?
you got to go walk into a modern data center, my friend, because there is a revolution happening there. Knowing, not divulging anything from Intel, but they're at 20 nanometer technology with a plan to get to 5. I mean, so there is no end in their ability and their desire to drive Moore's Law. So if you look at what's happening here at Google and Facebook and other places, that is now rippling through enterprises, right? They are now taking modern data infrastructure, and they're effectively, you can customize a server pretty much on the fly and build it for application-intensive workloads, compute-intensive workloads, storage-intensive workloads, and then mix them. So I'm not sure that what you say is correct. I think those barriers are always there, but I think if you go to some of the modern data centers that are happening today, there's some really cool things going on. I don't think that's the limiter at this point.
Okay, yeah?
So there's a number of companies, some of which were on that chart, and a few high-profile examples that have reached valuation levels that put them out of reach of M&A, and simultaneously have very, very high cash burn. What happens to some of these companies in the absence of a public market transaction, an IPO? And what could be the broader implications of something happening to those companies where there's a massive down round or M&A transaction that occurs well below the last valuation that occurred? What could be the broader implication? Could that be a catalyst for a downturn?
I mean, certainly often discussed when raising these big rounds. I'm sure Cloudera had the discussion. It's been publicly reported, in our portfolio box and DocuSign and Twilio and Shopify, and a number of these companies have raised, large rounds in these valuations. Pinterest, Yelp, LinkedIn, et cetera, before them. One of the benefits as entrepreneurs is you can take liquidity along the way now. It's no longer looked at as a massive negative, and so it's not a binary, I let it all ride or I sell all now. And so there is a way to get the best of both, which is put the money in the bank account so that you can always buy that house, your kids will always go to college and be funded, those sorts of things, and you can play to win. And particularly in those late stage cases, as investors, we increasingly believe that can make a lot of sense, so that it's not a hyper stressful all-in situation, and you can walk that line. But there's no doubt about it. At that point, when you're into the billions, you're playing to win, and you've priced yourself out of most active M&A buyers. And so there's going to be another side of that story where some of those companies played it too aggressively and lose. And that's the nature of tech. That inevitably there's some filter here, and there's some businesses that have missteps, and so we will see that happen probably within our portfolio, and certainly on that chart more broadly. And hopefully those companies, because they're still, to Jason's earlier point, these aren't zero revenue, big idea companies with massive burns. These tend to be high ARR businesses that are growing fast, and they're just burning for growth. They're not forced to do something against their will, in that they should have enough cash buffer, enough business model control, where the downside there is you can't go public at a big number, and you pull back spend, you manage to break even, and you, in many cases, throw off cash. But there will be more extreme examples, and unfortunately, I'm sure we'll see it in the next pullback.
Yeah.
For A-round investors, so when you guys are looking to the startups, and other than you look into the project, the team, or the tractions, do you guys look into the seed round investors? Who are your ideal investors you want to they are with you guys as investors, or do you care about percentage-wise how much they take from the company, or some investors you guys don't like at all?
I'll name them for you guys.
Just the really bad
I'm kind of agnostic on who the angel investors are. I mean, obviously, if I have a relationship with them and I trust their opinion and they forward me the opportunity, I'm going to look at that a lot more than I would look at something that came over the transom or with people that I don't know. Because a lot of this business is about trust. And so we do rely on those relationships that we built over time to kind of short circuit the due diligence process, right? So that's important. So I do think if I had a choice as an entrepreneur, I'd choose angel investors that have relationships with the kind of institutional investors that you would want to ultimately attract. I do see companies making mistakes of selling too much of their company at the angel stage. One of the things I love is when I'm backing an entrepreneur and he has a huge stake in the business, because I want them to be incredibly motivated to build, a great company. So if they're already at the first or second institutional round down in the single digits, that can be problematic. It's just not enough ownership to go around. So I like seeing
seed rounds.
right. Seed rounds take only 10 to 20%, let's say the company would be my ideal. But I think those are just rules of thumb. To me, surround yourself with quality, the highest quality people you can, and then be very disciplined about the amount of capital you're taking. So, because if you're being successful, you'll be able to raise it at a much higher valuation down the line. So.
Okay, well, let's please thank this panel. This was a terrific.